M&M Finance came out with its numbers yesterday. A big disappointment. The results were below estimates. The net interest margins also contracted, and you had a strong disbursement growth, though that continued. Let's touch base then with the management to find out what the road is ahead. Joining in is Mr. Ramesh Iyer, Managing Director at M&M Finance on the show. Mr. Iyer, thanks very much for being with us. Let's start off by talking about the overall margin picture then. How were the yields as well as the overall cost of funds in the first quarter?
As far as the cost of funds are concerned, against all expectations that interest may come down, that did not happen, and it's remained kind of almost flat at about 10% for us. As far as yields are concerned, there's been no pressure on the yield, but definitely one sees a product mix change because we now got into little more of cars, we've got into financing of the LCVs, construction equipment, which normally come at a low yield, and therefore one would see that the yield is slightly dipped, but it's nothing to do with the lending rate dip. It's only the product mix change which has caused that, and therefore we've not seen any major pressure on the margin front. But I must quickly kind of add here that we've taken enough measures to ensure that our cost of running this business, the cost of operations, have actually come down a little, and that's helped us retain the margins.
Mr. Iyer, morning. What about the asset quality, the gross and NPAs, gross and net NPAs? How did they shape up? And now the question really is that the asset quality also looks under pressure.
If you look at our balance sheet historically, the semi-urban rural market will always see this trend of the first quarter going up, the second quarter continuing to remain there, and then on it tampers off as the season starts to begin. So you can look at historically, it moves up from the March level to a 3.94, 4.2 levels, and that's where we are today. So I don't think there is something very unusual about the gross NPLs being where it is. But I must tell you that yes, there is some pressure from the southern market. It's not doing as well as the other markets are doing. And two, we also have a very small exposure of commercial vehicle, and as you know, commercial vehicle segment isn't doing well. And these two together would have pushed it from a 4% level to maybe a 4.22% level. As otherwise, in the rural market, we are not surprised with this behavior. That's been the historic trend.
What has been your securitization income, and how do you see the securitization market shaping up?
Actually, in this quarter, we've done no securitization at all. And in fact, the ones which have been done in the past are also being accounted only on the cash basis, and therefore the incomes actually are lower by about 10-12 crores of rupees. Otherwise, there's been no securitization. And even if you look at kind of whole of last year, only the last quarter did we do some securitization. And while we'll keep it in our liquidity plan, but as I told you, in this quarter, there's been no transaction at all.
Now, your assets under management have grown by over 30%. So would you expect similar growth for FY14, or do you think you might see some slowdown?
I may not want to put an exact number to it, but we've seen it again all time in the past, that the rural market normally picks up extremely well in the second half with the festival season, wedding season, and then the harvest in the last quarter. And therefore, if the volumes hold on to the rural market the way they were, I think for us the growth should not be a challenge in itself. We are not overly pressurized on the growth front.
Okay, Mr. Iyer, let's talk about the long term. What's the future outlook for margins, and how would your cost of funds shape up post the RBI measures?
We clearly expect that the cost of borrowing is likely to go up, and we are clearly preparing ourselves to say that if the cost of borrowing had to go up, we would try and clearly push up our lending rates to customer as well. And the lending rate push sometimes does happen that the dealer and the manufacturer step in and offer subventions. But we convinced that if the borrowing cost had to go up, this round we may have to push up our lending rates as well.
And before we let you go, Mr. Iyer, give us an outlook on the asset quality front as well as the provision covers that you're likely to maintain over FY14.
See, there's something that I may want to quickly explain on the coverage ratio. When the NPLs are the fresh NPLs which have just come into the NPL first bucket, you will always have the provisioning at a low level, which means that the correctability of these NPLs is much, much higher as an opportunity. And as I've been repeatedly saying, one always expects that the second half cash flows of the rural are much, much buoyant as compared to the first two quarters of any particular year. And we would not be overly concerned at this stage that is there anything to too much worry about the NPLs. But clearly, yes, the efforts will be continuing to focus on better recovery and ensure that the quality of asset doesn't drop down. Two, our LTVs have remained at 70-75%, which actually is the support for a better quality of asset because the customer interest to repay is always much, much higher.
All right, Mr. Iyer, we'd wrap it up then on that note. Thanks very much for joining in today, and of course all the very best for the future quarters as well. And asset quality will continue to be a key concern for all the NBFCs really.